चलो गुड इवनिंग एवरीबॉडी। आई होप आई एम ऑडिबल और आई होप आपको स्क्रीन भी नजर आ रही हो। वी आर ऑन यूनिट नंबर 2। वी आर ऑन यूनिट नंबर 2। यूनिट नंबर 2 में एक मिनट है, देर आर अ फ्यू पीपल इन द वेटिंग रूम। वी आर ऑन यूनिट नंबर 2। यूनिट नंबर 2 के अंदर जस्ट अ सेकेंड, लेट मी जस्ट शो यू द इंडेक्स ताकि आपको बराबर से आइडिया पहुंचे। वी आर ऑन यूनिट नंबर 2। इन यूनिट नंबर 2 we have completed risk and return. We have completed corporate restructuring. We have completed raising capital. I'm going to complete working capital management part 1 today because working capital management part 1 अपने आप में ना रेशियो एनालिसिस का रिवीजन। मुझे इस बात से बहुत कंफर्ट मिलता है कि रेशियो एनालिसिस करते हुए we have taken a sufficient amount of time for discussing current ratio, acid test ratio, and all those ratios that are connected to working capital in various ways. तो इस बात से ये जो आपका चैप्टर है अभी का, ये काफी इजी तरीके से हम कंप्लीट कर पाएंगे। दैट इज माय फर्म ओपिनियन एंड बिलीफ। तो चलिए डिस्कशन चालू करते हैं। वर्किंग कैपिटल क्या होता है? सबसे पहले लेट अस टॉक अबाउट दैट फॉर 5 मिनट्स ताकि आप समझ पाए वर्किंग कैपिटल का मतलब क्या होता है। देखिए, आज की तारीख में आज की तारीख में इफ आई वाज टू से दैट आई वांट टू स्टार्ट अ बिजनेस एंड दिस बिजनेस इन्वॉल्व्स द मैन्युफैक्चर ऑफ गुड्स एंड provision of certain services. Manufacture of goods will require me to have a factory, will require me to have property, plant and equipment, जिसे हम पहले मशीनरी बोला करते थे। It will require me to have certain vehicles for delivery and certain other fixed assets. Please understand, my dear friends, that these assets are my long-term assets. Do you agree or do you disagree? What is the meaning of long-term assets? It will be used for more than one reporting period. Do you agree with this? It will be used for more than one reporting period. मतलब हम कहते हैं कि it will be used for more than 12 months. क्यों? क्योंकि one reporting period for us is generally a period of how much, guys? 12 months. Agreed, everybody? Yes or no? Are you with me on
Yes.
that? Yes, guys?
Yes,
साक्षी,
sir.
आर्यन, अपना लोकेश, निखिल, मुस्कान, हरिप्रिया, everybody, you all are with me on that? That you will require these items also. But along with this, you will also purchase raw materials. For this, you may purchase it on credit or you may purchase it immediately on cash basis. Then you will manufacture and you will sell the goods. These goods, when you will sell it on credit or you will sell it on cash basis. In after purchase of raw materials, you will have, I will write over here 1A because they are related. You will have various expenses. What kind of expenses you will have? You will have salary to pay, which is going to be obviously monthly on your part. You will have various utility bills. For example, electricity. For example, gas. For example, water. You will have taxes to be paid. And you can have various other expenses also. You can have certain other expenses. Like what other expenses you can have? You can have showroom rent, so on and so forth. But all of these items have to be paid on an immediate basis. They are short term as far as you are concerned. For long term, for creating this factory property vehicles, what you require is long term financing. And for creating this short term, what you require is short term financing. Short term financing is done by the use of working capital. Working capital is very simply put your current assets minus your current liability, which is nothing but net current assets, or you will call it working capital. Working capital gives your company something known as a liquidity, and long-term financing gives your company something known as a solvency. I would like you to keep these aspects in mind. This particular chapter that you are going to enter into deals with working capital, means it deals with the short-term financing and liquidity aspects that we are going to now discuss. Luckily for us, we have already done items like current ratio, acid test ratio, अपना debtors collection period, creditors payment period, inventory turnover ratio. So tonight after the lecture, on an immediate basis, you will be requested, expected to go back and revise the ratio analysis part of this from our Google Sheet. You will see that this chapter is nothing but an extension of that ratio analysis discussion. Now we will go through every aspect of the text. Working capital policy and working capital management involve managing cash so that a company can meet its short-term obligations and include all aspects of administration of current assets and current liabilities. Always remember one funda as far as business is concerned. And let me tell you this very, very clearly. That funda, simply put, is cash is king. What is that funda, my dear students? What is the funda? Cash is king. I won't say many years ago makes me sound like an old man, but I will say approximately uh, this was somewhere in the year 2018, I will say 6 years ago. I had the opportunity to meet and coach in a business incubator. Now, a business incubator is a very, very interesting place because you get so many new people to meet, so many new business ideas are there that you are astounded by what kind of things can be done in business. I remember there was a business that I had come across that was so innovative in itself that I did not even realize that a mobile camera taking certain pictures of certain items can create so much cash flow for an entrepreneur. But fantastic. Now, in this business incubator, I got to learn a lot about something we call as startups today. Startups is a fancy word for business. It's just that it's a new age word. And many startups are prone to failure. This is an unfortunate reality of everything. They are what? They are prone to failure. Why are they prone to failure? They are prone to failure because of something known as cash burn. What is the meaning of cash burn? Number one, not enough cash generated to survive. And the second reason is expenses are more than income and there is mounting losses. This is what happens in case of cash burn and eventually the business dies out. This is what happens for startups. And believe me when I say this, 90% to 95% of the startups fail because of cash burn. Cash management is what keeps the business alive today. Working capital management or working capital, I'll write it over here, management is nothing but cash management. What is the essence of working capital management? The essence of working capital management is only and only one thing. You have to pay and you have to receive. Make sure that you have to receive in X days and you have to pay in Y days. Let us say that you have to pay in 10 days. And if I say that you will receive in 12 days, matlab kya? I have to pay you in 10 days, but my money is going to come in 12 days. So in this situation, cannot pay. Cannot pay means failure. But suppose if I say that you have to pay in 10 days, but you are receiving the money in 7 days. So in this case, in the case of the pink, you can pay. You can pay means you can survive. How you can pay? WCM, working capital management, and the fact that you are going to receive faster than what you have to pay is good cash management. I want you to remember this. The fact that you have to receive faster than what you have to pay is good cash management. And this is all that this chapter is about. What is working capital? Is defined as the difference between current assets and current liabilities. You are already aware of this. We have already done it. Now, what are current assets? They have given you a list of current assets and they have given you a list of current liabilities. I want you to always remember one thing, that prepaid items are always current assets. And in this, I want you to remember that inventory is a non-quick asset. Why I say inventory is a non-quick asset? Why I'm specifically saying like this? For a very simple reason, because when we talk about current assets and current liabilities, when we talk about current assets and current liabilities, the first ratio that comes to my mind is current ratio. And in current ratio, we have current assets upon current liabilities. But like current ratio is there, we have acid test ratio as well. What is acid test ratio? Quick assets upon current liabilities. So here we do not consider what? Inventory. Sir, why are you saying things that we are already aware of? Because look at what is the next thing. We will calculate the working capital, don't worry. But now look at what they are saying. Current asset, current ratio. Are you aware of current ratio? Do I have to explain this to you? Come on, honestly tell me, yes or no? I don't think so. We have got enough data on this matter. Yes, friends? You agree with my statement?
Yes.
We have done enough MCQs also about this, so not to be scared. But I want to discuss each of these theory aspects with you. I want to discuss each of these theory aspects with you. So please let us read these theory aspects. Let's get into it. First, evaluating the current ratio. Deteriorating current ratio. What is a deteriorating current ratio? It can be attributable to increase in liability, decrease in current asset, or combination of both. Now, what is a combination of both? I'm writing down over here. I request you to simultaneously copy down with me. Deteriorating current ratio. Copy down with me. You will agree with what I'm saying. Number one, current liabilities increase and current assets decrease. Number two, current liabilities increase and current assets are unchanged. Number three, current liabilities increase and current assets also increase, but current liabilities increase is greater than current assets increase. Fourth, current liabilities fall and current assets also fall, but current assets fall is greater than current liability fall. Because of all of this, what will happen? There will be a deterioration, meaning there will be a reduction. There will be a reduction. Now, Pushkar mathematically revise this for us. My dear friends, current ratio is current asset upon current liability. Whenever current liability is greater than current asset, your current ratio is less than 1. Do you agree with this statement? Yes or no? Please tell me that. Yes. Always remember that current ratio ideally, as a rule of thumb, should be 2:1. Why it should be 2:1? After paying the current liabilities, you should have an equivalent amount of current assets to keep the business going. Kindly keep that much in mind. So anything that happens, anything that results in overall fraction, what is the fraction? Reducing is deterioration of current ratio. Do you agree with everything that I have written? Yes or no? Please tell me that. Agreed? Yes or no? Please tell me that. Come on, guys, give me a
Yes.
response. I expect responses to come from you, especially Muskan, especially Sakshi, Nikhil. I expect responses to come from you because you are my February candidates. Agreed or disagreed?
Agreed, sir.
Agreed?
Agreed.
You can quickly copy this down. If you're copying, I'll wait. If you have already written, not a problem. And if you're even saying that, you know, not needed because it is all explained in your earlier lecture, I'll accept it because I know it has been done. So can I erase it? In case you all are not writing, can I erase it? Please, can you tell me? Can I erase it?
Yes, sir.
Okay. Now, improving current ratio. What is the meaning of improving current ratio? Over here, basically, current ratio will increase. Now, kindly keep one thing in mind. If the current ratio will increase, means current assets upon current liabilities, जो पहले था, अभी ये क्या बन रहा है? अभी का current assets upon current liabilities इससे ज्यादा है. It is more than that. So basically, current assets have increased and current liabilities have reduced. Current assets have increased and current liabilities also have increased, but current asset increase is greater than current liability increase. Second, current assets have fallen and current liabilities have also fallen, but current liabilities falling are greater, I'm so sorry, are greater than current assets falling. This is important. This but is an important statement, right? 1, 2, 3. Or current assets have increased and current liabilities are unchanged. Improvement in current ratio means what? Current assets upon current liabilities, the fraction has increased, meaning what? Numerator has increased over denominator. That's all. Improving current ratio. Why? It's an increase or improvement implies the increased ability to pay off current liabilities and may be attributable to an increase in current assets or decrease in current liabilities. Everywhere that I can see is an improved current ratio. Everywhere that I can see is an improved current ratio. Agreed, guys? Do you agree with everything that has been written on the screen? You'll agree with
Yes.
evaluation of current ratio so far? Next. What are they talking about? Limitation of this current ratio. Every ratio has a limitation. I want to tell you that every ratio in itself is restricted to 2 or 3 parts of the financial statements. Number one, it cannot cover the entire financial statements. It will have a very, very marginalized approach to look at the financial statements. Next, unless short-term liquidity is a relevant ratio, current ratio is not necessarily the best measure of the health of a business. See, I want you to keep in mind that if you are dealing with a business where liquidity is a challenge, then you will probably look at current ratio. I'm not saying no. But you need to understand that along with current ratio, there are various other ratios such as debt service coverage ratio, operating profit ratio, or I will write down the word profit ratios. And these profit ratios can be multiple. They can be gross profit, they can be net profit, they can be operating profit, they can be cash collection. There are so many ratios. Third, your debt to equity ratio. Fourth, your interest coverage ratio. Fifth, can be any relevant ratio with respect to revenue of the business. All these ratios have to be taken into consideration. Current ratio alone cannot determine good health of business. But yes, while I say this, I also believe in one fact that current ratio always shows whether company has cash crunch. And cash crunch is such a bad thing, ladies and gentlemen. Cash crunch is such a bad thing, my dear students, my dear friends. Is that cash crunch can make a good person or a good business look very bad. It can make it look very bad. So you should never have a cash crunch in life also or in business also. Otherwise, good people also end up looking like bad people. That's the problem, and that's why current ratio is very, very important. Kindly keep that much in mind. Now let's take this. A restaurant may have a low current assets and relative to this, but accounts payable, therefore a current ratio less than 1, but might otherwise be healthy in terms of cash flows increasing, good reputation, good location, limited long-term debt obligations. There are so many things where other ratios might be much better, and current ratio in itself might be a very, you know, uh, in a very good shape, in a very good format. So because of this, in many ways, current ratio is a isolated way of looking at business. Now over here, what are they asking you? They're asking you calculate the current ratio. I have complete faith and confidence that this can be done by you. You don't need my help in doing this. Am I right in saying this? Because we have done ample current ratio calculations. Yes or no, my dear friends? You tell me. Yes or no?
Yes, sir.
Similarly,
Yes.
over here, calculation of current assets and current liabilities. I have a complete confidence in you that you can identify the current assets, identify the current liabilities, and also calculate this on your own. Next, I want to make one clarification in front of you. Please remember that expenses are not a liability. Expense are expense only. Expense are expense item. And they go to P and L on the debit side. But when expense is outstanding, it becomes a liability. Now keep one thing in mind, my dear friends. Whenever you have a liability, it has to go to balance sheet on liability side. Okay, guys? But for double entry accounting, for double entry bookkeeping, what happens? Suppose if I was to say that salary paid is equal to 10,000 and outstanding salary, or I will say current year salary paid and outstanding salary of current year again is 2,000. How will you present this in the P&L account? You will say to salary 10,000 plus outstanding salary 2,000. So 12,000 will be your salary, and you go to the balance sheet. On the liability side, you will write down outstanding salary 2,000. Why is this included? Because this pertains to current period. Therefore, part of expense. This is payable expense. It is payable. Therefore, it is a liability. Therefore, it is a liability. Kindly keep this much in mind. Kindly keep this much in mind. I hope you are with me on that. Yes or no? Please tell me that. Yes or no? Do you
Yes, sir.
understand? You agree? This is something you have done since 11th standard. It's something you have done since 11th standard. And for somebody like me, for a long time, who's not been in touch with 11th standard, or for someone like you who does office accounts day in and day out, say Muskan must be doing accounts day in and day out, Alka must be doing, Nikhil Saravdekar must be doing, Lokesh must be doing they must be doing at a higher level, all of these guys. But somewhere or the other, this is a very, very basic thing with respect to accounts that they do. Divya, who's had a formerly accounting profile, will also agree with this. Haripriya, who has got an accounting profile, will agree with this. That expenses are not a liability. They are an expense item. They go to P&L. Expense is outstanding. If an expense is outstanding, it becomes a liability. This is something that we agree with. Are you all with me on that? Yes or no? Please tell me. So what is this? This is a
Yes, sir.
clarification. This is a clarification that all expenses are not liabilities. Only outstanding expenses are liabilities. Agreed, guys? Yes or no? Please tell me that. This is for your understanding. Sir, why are you writing this entire essay for us? I would like to bring it to your attention. Now, this can be seen in the recording. Don't waste your time writing this. You already know this. Have that much confidence in your own abilities. Right? The way I have in your abilities, you have in your own. Don't have to start worrying and directly, "Kya re likha nahi likha nahi." Sir, why you gave us this explanation right now? My dear friends, please understand. Cost of goods sold is an expense. Salary is an expense. Rent is an expense. Supplies expense is an expense. Utility expense is an expense. These are not liabilities. These are expenses. Accounts payable is a liability. Salary payable is a liability. Bills payable, that is notes payable, is a liability. Common stock means equity share capital. This is reserves and surplus. So my dear friends, you completely understand that accounts payable and COGS are different. This is payable for business. This is payable for business. This is already paid for business. Do you understand this? Yes or no? Yes or no? I hope so. I hope so.
Yes.
So therefore, once you see expense word, students can panic and then they can say, ki, Arey, nahi, nahi, what if this is liability? No, I don't want you to panic. This is not liability. This is very much a part of your income statement only. I have touched upon the first heading of our this chapter, which is number 1, working capital. Our discussion is over. Second is financing decisions and working capital. Very interesting. Please understand. Now, what is the meaning of financing decisions? Please understand what I'm trying to say. Now, please remember that working capital is funds needed to manage the business on day-to-day basis. What is day-to-day basis? Short term. So working capital is nothing but short-term funds. Short-term funds comes from 3 sources. Sir, what are they? Number 1, revenue. Sell, create money, pay off. Number 2, from long-term capital. But if this happens, it is very, 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 very bad for the business. Why? Long-term capital should always be applied for long-term assets. For example, if there is a couple, they have purchased a house. There is a couple, they have purchased a house. Now the lady has certain gold ornaments. Now the gold ornaments are kept and a gold loan is taken and that gold loan is used to repay the housing loan. Is this a normal thing? Yes or no? You tell me that. Yes or no? You tell me that. Is this a normal thing in life? You have heard of people who have done this and it happens to 80% of the people. They want to quickly pay off their housing loan. So what they do, they take the housing loan, they take the house, they've got the good income. The money also they are paying income wise, but they also keep some gold, they keep it aside and they say, no problem, we will first finish off the housing loan. Agreed, this happens? Yes or no? You tell me.
Yes.
Normal?
Yes.
Normal?
Yes.
Now suppose there is a couple, the lady has kept her ornaments under mortgage and the gentleman has kept his car or some other property under mortgage and they are taking the money and they are paying electricity bill, they are paying gas bill, they are paying servant salaries, they are paying children's school fees. Is that acceptable? You tell me, yes or no? I say no. Why? Because long-term capital, like the gold ornaments for a family, should be used for creating long-term assets like a house for the family. Similarly, the long-term capital of a company, which is equity or debt, should be used to create the long-term assets. Always keep one thing in mind. Long-term assets should be created from long-term capital. The long-term assets will create the revenue and revenue will be used for working capital. So, long-term capital will give birth to long-term assets. Long-term assets will give birth to revenue and revenue will pay off working capital. Understanding? Yes or no? Please tell me that. Yes or no? Please tell me that.
Yes.
And third sources are short-term borrowings. My dear friends, one superb example of short-term borrowing is overdraft, unsecured loans, business loans. These are what? These are operating, these are money used for managing the operations in the short run. They are not for a long period. They can be for a period anywhere between 12 months to 36 months, where you are paying off the loan and are able to manage. So these short-term funds of working capital can be derived from revenue, long-term capital, and short-term borrowing. You should always, for good health of the business, derive them from where? Maximum you should derive from revenue. Long-term capital you should never take. You should never take, and you should take this when? If revenue is insufficient. If revenue is insufficient. Are you with me on that, ladies and gentlemen? Yes or no? Please tell me this. Do you understand this concept?
Yes.
Do you understand this common sense? Yes or no? Kindly confirm with me.
Yes.
Yes or no? Yes? Logical? Come on, guys.
Yes.
Agreed? Now, my dear students, financing decisions of working capital are from where you are going to get this working capital. ये पैसे आएंगे कहाँ से? Where will you get this money from? That is the question. And that question is going to be answered in this second part that we are going to read. In a way, by explaining this to you, I have already finished my discussion. But we have to analyze each one. First is short-term financing. What is short-term financing? Short-term financing is short-term loan which you have to repay within 1 year. Mature within 1 year. What is the meaning of the word mature within 1 year? The meaning of the word mature within 1 year is that you have to pay it within 1 year. Rates. What are the rates? These are interest rates. Always keep one thing in mind. Short-term financing, STF, interest rate will always be less than long-term financing interest rate. Why? Because the duration of short-term financing is less. Because the duration of short-term financing is lesser. Please keep that much in mind. Are you with me on that? Yes or no? What is the effect on
Yes.
working capital? Effect on working capital is that, number one, if you take a short-term financing, cash will increase because money will come. Let us pass a basic journal entry. Let us pass a basic journal entry. Short-term loan is taken. What is the journal entry? Debit, what comes in? Bank account debit to short-term loan. Agreed or disagreed? Please tell me that. First entry, yes or no? Now, why are we
Yes.
taking this short-term loan? To pay the certain expenses. So here, short-term loan funds are used to pay expenses or creditors or liabilities, whatever. So debit all expenses and losses, or debit your creditors, accounts payable, outstanding expenses, anything, account debit to bank. And this is that same bank account that is going on. Third, what will happen? Interest and principal due on short-term loan. My dear friends, over here already you have passed an entry for principal due. You have already recognized a liability over here. Yes or no? Please tell me that. Yes or no? So now interest due. How do you pass an entry for interest due? Interest is an expense. It has to be debited. So your entry will be interest account debit. You have not yet paid it. You will create a liability to interest payable. Now please notice that this is your first liability and this is your second liability. So what has happened inherently, that short-term loan taken results in current liabilities increasing and your current ratio will reduce. Sir, how come current liabilities are increasing? My dear friends, please notice that this is your liability 1 and this is your liability 2. Whatever temporary money you got, that you have already expensed out over here. Always remember, this is temporary. Agreed or disagreed? Please tell me that. Agreed or disagreed? Please tell me that. Yes or no?
Yes.
Agreed? Yes? Sure? Therefore, can I say that this particular statement that is written over here, that short-term financing is classified and it decreases the working capital, is an absolutely true and justified statement. And I have clarified that with the help of the journal entries. Do you agree with me? Yes or no? Please tell me that. Agree with me? Yes or no? Please tell me that. Yes or no?
Yes.
Agreed, guys?
Yes.
Come on, guys. Yes. Super. Let's go ahead. Let's go ahead. What are the advantages? Profitability will increase if you are taking short-term loan. How? Well, why will profitability increase? Because you will use short-term loan to create current assets such as raw materials. You will create, these raw materials are there. You will buy the finished goods, whatever. So basically, what will you create? You will create an inventory. Inventory will result in revenue increasing. Increased revenue will result in debtors increasing or cash increasing. So obviously your profitability will increase. Are you understanding? Next advantage is that it will have a decreased finance cost. Why? Because rate of interest of short-term loan is less than long-term loan. That is why it is a decreased finance cost. But you have an increased interest rate risk. Yes, interest rates can suddenly abruptly change. For example, based on budget, RBI decides to change interest rate. For example, based on forex market, RBI decides to change interest rate. So suddenly they can change the interest rate. Yes or no? Yes or no? Yes. Now understand one more thing. The next one is an interesting aspect, that is decreased capital availability. Why decreased capital liability? If you have borrowed a loan, kindly keep one thing in mind. If you have taken a short-term loan, what will a lender think? Now, I'll give you a fantastic example. I'll give you a fantastic example of what story was narrated to me by a known person. So this very dear friend of mine told me that there was a shopkeeper that was known to this person's father. Now listen to this story. Listen to this story. There is a shopkeeper. He has a big shop, very big shop, lots of customers. And this shopkeeper is very respected. You can imagine, na, in your locality or in your suburb, there is a very big shop. Now, for example, I'll give you an example. For somebody who probably stays in and around, say, you can say Chembur, and you go to a place called Jama Sweets. So Jama Sweets is a very well respected shop. You are staying, for example, at Bandra West. Amar Sons is a very big shop. So like that. So the shopkeeper owner is very respected. It's a very big shop. There are lots of customers. Now there is a businessman. Now this person is wealthy person. Okay. Now this shopkeeper approaches this businessman for a short-term loan. The businessman asks him, how much you want? I will give you subject to certain conditions. Certain conditions are there. I will give you. Plus there will be an interest. Shopkeeper says agree. Shopkeeper says to this statement, sir, I agree. Says, sir, I agree. Okay. Businessman asks him first question, how much you want? Shopkeeper says 2 lakh rupees. Businessman says, sorry, I cannot give you loan. Somebody will say that why a wealthy businessman who can easily afford to give 2 lakh rupees to a big shopkeeper and earn an interest on that is not willing to do so. Businessman gives a justification. This shopkeeper has a daily turnover of no less than 40,000 rupees. Of no less than 40,000 rupees daily. Therefore, 40,000 multiplied by 30, he is making 12 lakh sales per month. In this, his profit is at least 70%. So 8,40,000 should be his cash generated. For a businessman who is generating 8,40,000 in profits every year and has been doing business for more than 20 years, If he suddenly comes to me and asks me for 2 lakh rupees, which is such a small and petty sum for such a big shopkeeper, small petty sum, I know that something is seriously wrong in his finances. And if something is seriously wrong, my money will get stuck. And I am not in the business of taking a risk. I am in a business of lending to worthy parties. Do you understand the justification of this businessman? Yes or no? Please tell me that. Yes or no? Please
Yes.
tell me that. Agreed or disagreed? Agreed? The
Agreed.
businessman said, see, suppose if the shopkeeper would have come to me and said, I need 40 lakhs, I would have considered. I would have considered. I would have given also. I would have asked for a percentage, a profit. I would have recovered my money one way or the other. I would have asked for some security, the shop papers or the car papers or some other small gala papers. I would have asked for it. But for 2 lakh rupees, what security are you going to keep? What are you going to keep? A wristwatch, a mobile phone, iPhone, small car. What? What can you keep for 2 lakh rupees? Inventory. What will I do with your inventory? I can't do anything. Will I eat it? I can't. So your credit worthiness depends on your loan demands. Kindly understand this, ladies and gentlemen. Kindly understand this story. This story has been narrated to you with a logic. So please understand that a decreased capital availability means the lender will take your credit worthiness, and if you have too much STL, that is short term loans, if you have too much, or too many short term loans, then what will happen in long term? Raising capital will become very difficult. Are you understanding what I'm trying to say, ladies and gentlemen? In long term, raising capital will become difficult and there will be a decreased availability of capital in long term. Are you with me on that? Yes or no? Please tell me. Are you with me on that? Yes
Yes,
or
sir.
no? Please tell me. Yes or no, guys? Agreed?
Yes, sir.
Agreed? Okay. Long-term financing. Now, what is long-term financing? See, please remember, long-term financing means long-term money. Long-term financing means long-term money. This is used to create long-term assets more than 12 months. You will remember that in this lecture only I have spoken about this. Always keep one thing in mind. Long-term financing should always be applied to create long-term assets and never used to pay the short-term expenses and never used to pay the short-term expenses. Why? Because, one second, huh? Just guys hold on for 1 minute. Huh? Just allow me to take one call. Just kindly hold on. Thank you for waiting. Sorry, I had to take a call. Let's continue. Now we are talking about long-term financing. As I was saying, I'll just rewrite it because the link was broken. Long-term financing can never be used to pay the short-term expenses. Rather, can never be the wrong word. You should use the word should never be used. What is the effect of long-term financing on working capital? First of all, long-term financing is not a part of working capital. And that is exactly what is being written over here. That is exactly what is being written over here. Long-term financing is classified as non-current and is not included in calculation of working capital. However, dividend, interest, and principal repayments all require the cash, which can reduce the working capital over a period of time. Yes, there arises no doubt. Whenever you have a long-term source of funds, such as debt, against this, what is the cost of the funds? What is the cost of debt? The cost of debt is interest. Please remember this. Cost of debt is interest. First point. First point. Cost of debt is interest. Second point. Second point. What will debt be used to create? It will be used to create long-term assets. Long-term assets will create what? Revenue. Revenue will be used to pay what? Interest. Please understand this. But sometimes when you don't have the revenue, out of this debt only that you have taken, suppose you have taken a debt of 10 lakhs. Okay, and on this, suppose your EMI, for example, is say 25,000. Suppose this is your EMI. Suppose it is 25,000. Now, please understand, if this 25,000 is paid out of 10 lakhs, then this 25, this is a very bad sign. This is very bad. Do you understand? आपने ब्याज कर्जा लिया, you took a loan, and out of that loan only you are paying EMI. No, boss. This EMI should be paid from your income. Should be paid from your income. This is basic financing. This is rich dad, poor dad. This is rich dad, poor dad financing. How do you get that? You need a revenue for that. This is the basic common sense. So basically, whenever you are paying this interest, what is this? This is cash goes out. And the fact that cash goes out always results in current assets reducing. So kindly keep that much in mind. Long-term financing, the cost of long-term financing will always result in and what is cash outflow? Cash down. Since cash is down, therefore current assets are down. Do you agree and understand this statement? Do you agree and understand this statement? Yes or no? Please tell me that. Yes or no? Please tell me.
Yes, sir.
Agreed? Okay. Next statement. The extent to which an organization uses long-term financing is depend upon the amount of current assets it maintains and the risk of tolerance of the management. Meaning, what are you using the long-term financing for? Always remember, long-term financing is a borrowing. What is a long-term financing? It is a borrowing. Borrowing results in interest risk, which is nothing but a financial risk. And a financial risk is nothing but financial leverage. It is nothing but financial leverage. So I hope everybody understands that long-term financing is nothing but financial leverage being increased. What are the advantages? Decreased interest rate risk. Long-term financing locks in an interest rate over a long period of time. Therefore, even if there is a long-term exposure, it is taken care of because when the principal amount is large, fluctuating rate of interest may not be applied. Increased capital availability, you will have more capital to use. Decreased profitability, why? Because you have to pay higher installments so that your profit is going to repay the money. Increased financing cost, yes, there is an increased financing cost. From your perspective, you are paying the money. From the lender's perspective, what happens? From the lender's perspective, he has a interest rate risk. What? Suppose if RBI has increased the interest rate from 8% to, let us say, 12%, 10%. Now he has given you the interest at the rate of 8%. Now he wants to increase the interest rate to 10%, but he cannot increase it. Why? Because there is a locked-in interest rate over a long period of time. Meaning, because of the fixed interest rate, he cannot increase it. Kindly understand this much. Yes or no? Please tell me that. Yes or no? Please tell me that. Are you with me on that?
Yes, sir. Yes.
Yes. Okay. Interest rate risk, borrower's perspective. What is the borrower's perspective? See, borrower will lock themselves in a long-term interest rate to reduce their exposure and pay a premium to do so. What is the meaning of pay a premium? Pay a premium means there will be a higher processing fee. For example, the loan amount, suppose it is 6 lakhs. Okay. And the processing fee, suppose it is 16 lakhs. And the processing fee, suppose they are charging you 81,000 rupees. My God, as close as 1 lakh. So how much money is falling in your hands? 5 lakh 19,000. On how much you are paying interest? On 16 lakhs you are paying interest. Interest भरा 16 lakhs पे, पैसा use किया 519. This is what you use. This is what you pay. There is a disparity. There is a disparity. Why? Because they are paying a premium to do so. So whenever there is a long term, there is always going to be a high processing fee. Keep that much in mind. And you will notice that high processing fees are paid in long-term loans of 5 years and above. You have to remember this. Conservative approach. What is the conservative approach? Always have high sales. Ensure that current assets are high. Ensure that current liabilities are kept low. And you are using the revenues generated from operations to ensure that all your current liabilities are paid off. Kindly understand this much. Are you with me on that? Yes or no? Yes or no, guys?
Yes.
Next,
Yes.
maturity matching approach or hedging approach. What is the meaning of this? Whatever risks are there of the current liabilities, current assets are used to match against that. For example, if there is, say, a short-term loan that is taken of 2 years, okay, the interest rate on this is suppose 12%. How do I reduce the risk of this? I immediately place an FD, or I have an FD in place already, which is for a period of, say, for example, 2 years. And on this, the interest I'm getting is 8%. So somewhere or the other, a 4% burden is borne, and the principal amount is set off against this, and the interest is set off against this. Kindly keep that much in mind. Yes or no, please tell me that. Yes or no, please tell me that. Yes, guys?
Yes, sir.
Yes? So what happens because of this? You use your assets to hedge, that is reduce risk from liabilities. Do you understand? Yes or no? I remember, I was standing in a bank queue one day in Cooperative Bank few years ago, and there was a person, he wanted to take a car loan. So this banker was telling him, he said that car loan directly we don't give like this. We give it only for commercial vehicles, and you want it for personal use of car. I will tell you one thing. Why don't you do one thing? You make an FD with us. You make an FD with us. We will give you 8% interest, and we will give you a loan at somewhere around 11%. 3% will be your cost. That you bear it. That you bear it. And even if you default on the loan, it's okay. We will eat up the FD, so you will not have a bad credit rating. 3%. He felt it was reasonable. He felt it was reasonable, and he took it and he went ahead with it. Are you understanding what I'm trying to say? This is exactly what he did. He took a short-term loan of 2 to 3 years, kept an FD of 2 to 3 years, used the interest rate difference, and he said, I'll pay off this from my salary. I don't mind, but I need urgently vehicle for my family's certain emergencies. I said, okay, I mean, it's a good idea, I said. I was thinking, I came home, I discussed it, I shared with my dad. I was in college at that time. My dad said, look, it happens. Depends what person is comfortable with what. And I learned at that time that these kind of things also happen. So keep your eyes and ears open. I mean, that's what I can tell you. Next, aggressive approach. What is aggressive approach? Aggressive approach means take the debt, pay off the liabilities, interest का बाद में देख लेंगे. Take the debt, pay the liability. We will see what to do with the interest later on. A company who has followed an aggressive approach today and is suffering is Byju's. Byju's has taken a horribly aggressive approach, because of which its investors are also not happy, and it has taken such big risks. Who are the brand ambassadors of Byju's? Shah Rukh Khan, who charges crores of rupees. You know that Byju's has approached Lionel Messi to be its brand ambassador? Lionel Messi. You think Lionel Messi is a cheap affair? He is probably the greatest football player in the world today. Maybe Maybe Cristiano is the second fellow. But Messi, as your brand ambassador for a coaching classes, that too where the fees are so less, are you out of your goddamn mind? It's as good as me saying, going to say Ranbir Kapoor after Animal and saying, boss, why don't you become my brand ambassador? It's madness. I can't afford bloody Shakti Kapoor and I'm going to goddamn Ranbir Kapoor. Are you fucking crazy? You must understand these aspects. You must understand these aspects. Next part is cash budget. Now, cash budget means how to do the cash management. Now, for this, you have to learn the entire cash budgeting. Now, over here, I am going to totally slash off one part of your chapter. What is that? Operating cycle and cash conversion cycle. I am going to knock this out because operating cycle we have already done. Cash conversion cycle we have already done. Days in inventory is already done. Days in accounts receivable is over. Days in outstanding accounts payable, this is all over. Methods to accelerate collection is over in our MCQ. Is over in our MCQ. So this last part of chapter, that you can see, this third part, sorry, half of it is completely over. Are you with me on that? Cash budget I'm coming to. But this part, motives for holding cash, is completely over. Please keep that much in mind. Please keep that much in mind. Now, marketable securities management is the next part of the lecture that I'm getting into. I just want to use the loo and come back, and I will just address this part. I will just address this part. Right? I just these theory parts I will touch upon. I want to come to the fourth point here. What is the fourth point? Or the fourth topic is marketable securities management. Now, what are marketable securities? Marketable securities are those securities that can be sold on a short-term basis. Basically, please understand, marketable securities are cash equivalents. Why are they cash equivalents? Because they can be sold on an immediate basis to generate cash. They are cash equivalent, means they're cash only. You can sell them and generate the money. What is an example? US Treasury bills. What are these? These are called government securities, GSECs. They have 30 days maturity, 60 days maturity, and 90 days maturity. You can sell them off and immediately recover the money. Next is treasury bonds or government bonds. They are again a type of a GSEC. Now, these can mature within 1 year to 10 years, or you can even go for 30 years. Now, what happens is they are not cash equivalents. These are not cash equivalents, but they can be sold on an immediate basis. But what the duration doesn't make them cash equivalents, but can be sold immediately. But they can be sold immediately. Because they can be sold immediately, they are considered to be common marketable securities and they are considered to be cash equivalents. Next point is federal agencies bond. What are federal agencies bond? A best example of this in India is Rural Electrification Corporation related bonds, National Highway Authority of India bonds. Who are these? These are federal agencies, agencies of the government of India, Rural Electrification Corporation, NHAI, etc. You know that there are the bonds of these available for investment in the market today. They are short-term investments. Why? Because although the duration is high, they can be 9 months to 30 years, but you can sell them on an immediate basis, and there is always a demand for these items in the market because these items always give you tax benefits. Because these items always give us what? They give us the tax benefits. Next, negotiable certificates of deposits. What is a negotiable certificate of deposit? For example, you have an insurance policy. You can use this and you can take a loan against it. Or you have a fixed deposit against which you can take a loan. So it is negotiable. Why? Because there is an underlying asset against which you take a loan. So they become certificates of deposit in a way because you are using these items, your assets, to take loans against it. So ideally, these can be sold in the market also, and you can take loans against it. Next is a banker's acceptance. This is nothing but a demand draft. This is nothing but a bill of exchange. This is nothing but an overdraft on which you can make money. Commercial paper. What is a commercial paper? Depending on your credit worthiness, a bank gives you a loan which is given in denominations of 1,000, 5,000, 10,000, 50,000, 1 lakh, etc. They have got maturity of 90 days to 180 days, etc. And they can be used by you to generate the money, and they are a short-term security. So you can take a commercial paper and you can sell it in the market, and then you can repay the loan that you have taken. Euro dollars. What are euro dollars? They are nothing but your currency deposited with international banks. What happens is, say for example, rupees kept in foreign account. There are three types of accounts: Vostro, Nostro, right? Nostro and Vostro accounts, two types, sorry. So you can keep your currency in a foreign account, and against that, you can take a foreign currency. It's a marketable security because you can now use this foreign currency for the foreign market. You can use this foreign currency for the foreign market. Therefore, this euro dollars in itself is a kind of a negotiable instrument that can be used. Next is money market mutual funds. They are nothing but your mutual funds that you invest in. A mutual fund can be sold on an immediate basis. Any one of you who ever invests in mutual funds knows that you put a transaction, you put a sale order, and within 24 to 48 hours, the amount gets deposited in your bank account. Are you understanding what I'm trying to say? Right? Next,
Yes, sir.
repurchase agreements. What are repurchase agreements? There is an asset. There is an asset. You sell that asset and then you take it back on lease. Similarly, there is, say, a government security. You sell it to somebody. Say you sell it to X. Now X has the GSEC, but X immediately gives you a loan against it. So what happens, that GSEC is basically kept with X as a security, and on this GSEC, which is otherwise a piece of paper, you are using that as a loan. So what will you do? You will repay to X the loan, and the GSEC will be returned back to you. So basically what you are doing, you are using your asset as a collateral. इसको गिरवी रखते हो आप, and against this you take money, and that money is used by you, and then you return the money and you take your asset back. This is nothing but a type of a mortgage agreement. Next are municipal bonds. Municipality issues bonds in foreign countries. These bonds are tax free and they can be sold on an immediate basis to get money. What are the factors that influence the level of marketability? How much liquidity is there? And what is the precautionary motive? Means how many of these securities are kept as guarantees for payment of a particular loan? That is the first thing. And second is the liquidity motive. The liquidity motive means what? How much cash flow you require, how much money you require. On the basis of that, you will then take into consideration how much of your marketable securities you really want to sell. This was your fourth topic. Now, what are the strategies of holding it? Depending on how much liquidity you want, depending on how much money you require, you are going to be holding this. So these questions, even if you read the textbook, there will be confusion in MCQs. For this, we have to sit and do the MCQs together with each other, which we will start from Monday to for the next 1 week or so, 10 days or so non-stop, and we will get the MCQs done. So you will be in position, MCQs and essays, and you will be in position to face the exams, right? Now, next part. The next part here is called as a cash budget. Now, what is a cash budget? Please understand. Let us discuss this question so that we understand cash budgeting. Now, see, in cash budget, what happens is when we look at cash, cash will always have an opening balance. Say for example 10,000. XYZ is wrong. Let's write 10,000. To this, you will always add your collections. They can be what? Collection can come generally in two sources. First is cash sale. Second is debtors collection. And third is asset sale. Whatever is the amount. Then against this, you have repayments or payments. We will say repayment or payment we will say. What are the payments that you have? Number one, expenses. Number two, interest and capital repayment, whatever you have to do. Right? Third, asset purchase. Money goes out in this. And you have to maintain a closing balance. Suppose you have to maintain a closing balance of 10,000. Suppose. In case A, you have 12,000 closing balance. What will you do? 10,000 is maintained as a closing balance. And depending on the question, this 2,000 excess may be invested. Why? Because that is excess cash. Now, whether or not this investment has to be done, it depends on the question. Case B, 10,000 is there. So this whole thing automatically becomes the closing balance. Case C, you have to maintain 10,000, but your balance is 8,000. So 8,000 becomes your closing balance. But what do you have to do for the other 2,000 shortfall? This shortfall, you will take a loan for it. What will you do? You will take a loan for it. Kindly keep that much in mind. For the shortfall, what will you do? You will take a loan. What is this? This is a pro forma of a cash budget. What is this? This is a pro forma of a cash budget. Kindly keep this much in mind. I would request that you copy this down. This is important. Please copy this down. I'm waiting. Please copy this down. Is it copied?
So 1 minute. Done.
XYZ has sales of 60,000 in February and 70,000 in March. XYZ forecast its future sale as follows. April, May and June, they believe this much sale will be done. At the beginning of April, the cash balance was 6,000. 20% of the monthly sale in cash, 20% is collected in next month, and the remainder is collected in the second month following the sale. I am interested in this. So, my dear friends, suppose if I was to say, for example, if I'm talking about April, These are forecasted sales. So, what are cash sale? This will be in April itself. This will be collected in. Now, for April, I'm talking. So, see like this: April, May, and June. Okay. Now, what is the April sales? 90,000. 20% is coming in April, it is in cash. 18,000. 20% is collected in the next month. 18,000 in the next month. What is the balance? 60%. How much is that? 54,000. When will it come? It will come in June. Do you understand April sale? Yes or no? Please tell me that. Yes or no, students? Yes. So
Yes,
can I
sir.
say like this for May? What is the sale of May? 80,000. So how much will come in May? 20%. Means how much? 16,000. June, how much? 20%. 16,000. July, how much? 60%. 48,000. April, May, June sale. How much is June sale? 1 lakhs. June, 20%. July, 20%. August, balance 60%. This is your cash collection from revenue. This is your fourth point. Other cash income is estimated about 2.5 thousand per month. So if I was to say in April, what are your inflows? Will it be 18,000 plus 2,500 other income? In May, what are your inflows? In May, I'm getting this 18,000 and I'm getting this 16,000, correct? So how much I'm getting? 18,000 plus 16,000 and 2,500. Agreed or disagreed? Then in June,
Agreed.
how much I am getting? In June, I am getting 54,000 plus I am getting this 16,000 plus I am getting this 20,000 and I am getting 2,500. Do you agree with this working? April, May and June. Please tell me. Please tell me. Come on,
Yes,
guys, tell
sir.
me.
Yes, sir.
Okay. Now rent expense is paid at the beginning of each quarter. Now April, May and June is a quarter. April, May, June is a quarter. Like this, July, August, September is one quarter. October, November, December is one quarter. So it is paid at the beginning of the quarter. Means in April you are paying 7,500 rent. Wages and salaries are 8,000 per month, all paid in cash. So in April you are paying 8,000. In May you are paying 8,000. In June you are paying 8,000. Company distributes cash dividend twice a year, 10,000 in June and 10 in October. So in June, along with this, you are paying 10,000 of dividend. Agreed or disagreed? Company is planning to purchase a new car in May. In May, you are purchasing for 7,000. Annual interest is due in May. So 4,500 is now due in May. Tax payment 5,000 is due in June. 5,000 I paid in June. Understood? So 9, 10, 11, 12. Convinced everybody? Yes or no? Please tell me that. Convinced?
Yes, sir.
Come on, students, please tell me yes or no. Agreed?
Yes, sir. Yes.
Agreed, students? Yes or no? Yes?
Yes, sir.
The minimum balance at the end of each month should be 5,000. If cash falls below 5, the company must borrow to cover the needs. Excess funds will be invested in the same local bank. Means if it is more than 5,000, you will give to bank and you will make FD or you will make RD. If it is less, you will take a overdraft loan from them. Okay, it is very simple. Now, my dear friends, these are the sales. Now, this is the budget. You have to make budget for April, May, and June. So, as you are aware, over here, let us see our calculations and let us see their calculations. What I said for April, your inflows are going to be April, your inflows, I said 18,000 and 2,500. 18,000 and 2,500. But February and March sales are also given to you. So if I was to talk about February sales, so can we quickly do February calculations? So February 20% will come when? In February itself. 20% will come when? In March. And balance 60% will come when? In April. What is February? 60,000. So my dear friends, 12,000 in February, 12,000 in March, and 36,000 in April. See here, 36,000. Agreed or disagreed? Yes or no, friends?
Yes.
Agreed?
Yes, sir.
Now let's talk about March. March, how much are your sales? 70,000. So 20% are coming in March, which is how much? 20% are coming in April, which is how much? And 60% are coming in May, which is how much? 42,000. So 14,000 of this, correct? In April. 42,000, ideally, you should see it in May. Yes, I am seeing it in May. Agreed, students? 18,000, we have already put a tick mark. We have already put a tick mark on all these other incomes. And these other fellows also, we have put tick marks in our earlier calculations. Agreed or disagreed? Come on, guys.
Agreed, sir.
Agreed?
Agreed, sir.
Okay. Cash purchases. Now, what are the disbursement? First, rent at the starting of the quarter. Wages and salaries 8,000 every month. 10,000 dividend. Purchase of a new car and interest payment and tax payment. All this you understand. Now, what are they talking? They are talking cash purchases. Let us specifically see the point of cash purchases now. What are the cash purchases? Cash purchases are given to you directly. So this is April, May, and June. So directly 60, 70, and 75. Directly 60, 70, and 75. So now please see here. 60, 70, and 75 you will find over here. 60, 70, and 75. You found this over here. And all other expenses we agree. Now this is your inflow. This is your outflow. This is your closing balance. This is A minus B. So my dear friends, let's talk about our month of April. What is my inflow? 70,500. What is my outflow? 75,500. So, what is my cash? Negative 5,500. What was my opening balance? My opening balance was 6,000. My dear friends, what was my opening balance? 6,000. Now, what is my net closing balance? My dear friends, 1,000. Oh. Yes. Oh, sorry, this is 5,000. Sorry. So net is 1,000. What should my closing balance actually be? It should be 5,000, no? It is given in the question, yes or no?
Yes.
It is given in the question, agreed?
Yes, sir. Yes, sir.
So if my closing balance has to be 5,000, I will have to borrow how much?
4,000.
Agreed? Similarly, here A minus B is minus 11. I have got an opening balance. April's closing is equal to May's opening. So how much do I open May by? 5,000. My dear friends, expected change is minus 11. So minus 11, I lost 11,000. I have 5,000. So minus 6,000 I have in hand. How much I have in hand? Minus 6,000. अभी मेरा बैलेंस माइनस 6,000 है पर मेरा बैलेंस प्लस 5,000 होना चाहिए. सो माइनस 6,000 प्लस x इज इक्वल टू 5,000. सो मैं बोरोइंग कितना करूंगा? 6 विल गो ऑन दिस साइड. माय आंसर विल कम 11,000. इसमें इनवेरिएबली ऑल CMA स्टूडेंट्स मेक अ मिस्टेक. You cannot afford to make this mistake. Am I clear about this? Yes or no? Please tell me that.
Yes, sir.
Yes or no? So this is your ending balance. This will become opening balance of next time. Now, this is your opening balance. This is your closing balance. Now, what is this? Net closing balance. So net closing balance is 500. You have to borrow certain money to make it 5,000. So how much you will borrow? 5,500. How much you will borrow? 5,500 funds to be borrowed. And with this cash budget, as an example is over, such a huge question will not come, but you will have smaller. ऐसा एक question, ये जो एक question है ना, इस पे कम से कम 8 से लेके 10 MCQs बन सकते हैं. 8 से लेके 10 MCQs बन सकते हैं. फॉर एग्जाम्पल, व्हाट वाज कैश कलेक्शन ऑफ अप्रैल, पहला MCQ, मई दूसरा MCQ, जून तीसरा MCQ, आउटफ्लोस कितने हैं वो, फिर एक्सपेक्टेड बैलेंस बिफोर बोरोइंग्स कितने हैं, आपके फंड्स टू बी बोरोड कितने हैं. ये जनरली मोस्ट आस्क्ड MCQ रहता है, फंड्स टू बी बोरोड कितने हैं. ये आपको MCQs में आ सकता है. Am I clear about this, guys? Yes or no?
Yes, sir.
Cash balances is over. This part of this theory I will do with MCQs, and apart from this, this entire chapter is completed. So we have finished working capital management part 1 chapter today. You are free to look at the Baker MCQs till tomorrow. Don't have to worry. Don't have to worry. We can comfortably discuss MCQs for this in the coming lecture. All right, guys. Thank you so much.